Okay, so this is Introduction to Break of Structure. My name's Mike, leader at Satoshi Trading, and this is our market structure basics course. So let's delve into breaks of structure. Now, we went over it in the previous modules and at the beginning of the course, so you could have a clear understanding when we got to this part of what this is. I'm sure now that you know about market structures and change of characters, how they're both the same, what they incline. This comes after the market shift. Some crucial concept that follows the market shift is a break of structure. It helps you then to understand market trends on a bigger picture so that you then can understand how to discover breaker structure signals that could give you potential shifts in the market and help you to identify trends and with its importance in anticipating market reversals and continuations. The main reason I want to show you this, guys, is because by the time you finish this course and you get onto the supply and demand course and the playbook, by the time you get that far, you should have a really extensive portfolio of things that you can use in time on the charts that will help you become a better trader. So, understanding breaker structure. This here was a continuation from a market structure shift, probably further from down here. It then came up, pulled back, and came into this order block here. You clearly see that's the order block. Now, it pulls back in and then comes up and pulls down, sweeping these lows here where the traders that think that this is the beginning of the bigger move get caught out by a quick liquidation before they send it to the upside and come back from the original move from the break. When it comes back, it comes down, comes into this fair value gap here, just tiny fair value gap here, and then wicks down and eats into the majority of this fair value gap here. Now, if you were positioned at this fair value gap here, you would have been filled and you would have had a really, really good trade. I was going to swear then, but I didn't. This would have been the ideal situation for you to get into the market. In this place here would have been the most extreme place for you to get in, for you to be able to have maximum gains. You would have ripped all the way back up there and all the way into a new high, creating new structure on the way up from this break here, which is probably a liquidation, a flush out for all the leverage people in the market. Okay, so then it comes, creates these new highs and falls, creating a swing fail here. A swing fail, you'll find out, like I said, on the supply and demand course, is when the high fails to swing above the current high. So that's an inkling for you to tell you that this is going to fail if it doesn't reach above. That way, you should be looking then to get into the market and position yourself into a short position on this side of the market. Now, the ideal place would have been for you to get into the market would have been probably, let me have a look, into this order block here. Not all the time you'll get, because there's no signal for you. You'll never always get the fair value gap entry. It'll usually be an order block or a mitigation block. That was a perfect order block tap into. It then came down, come back into the fair value gap and fell again, coming down into this order block here, which stopped it again in the market. Some tokens, coins, stocks, charts will run off different things. They won't always run off fair value gaps, and you'll have to work that one out. Is it fair value gaps? Is it supply and demand that it's working off? Is it different blocks that they're using to manipulate the market? So we come back up. We got a nice trade from this side of the market. We're now looking for a continuation or a trade from this side of the market. So we come back up after not breaking this high again. We come back down, and this now is where the break structure happens, okay? We would have had on this area here we would have had a market structure shift here. I don't put them on when I'm talking about one thing or the other because I don't want to confuse you. This is just purely breaker structures. So we come back down again and we tap into this low, taking out this low, and this creates a second breaker structure. We then come back up and test this high again. We do not come above the high that it continued, or this one, which means we continue further down. Now, what you want to be looking for at that point when it does give us this breaker structure is, does the swing break the high if you're going down? Or does the swing pull back, like, does it come and break the low below it? Now, if it does that, then it's going to come back down this way. And if it doesn't, there's a high chance that that is going to make another breaker structure further up the market. Okay. We probably had, when I put the market structure shifts on, this was probably a market structure shift, this here, and this is probably a market structure shift here or here. I would presume that this would be the market structure shift round about here, because that was the highest point before the fall down. And definitely this would have been taken as the high that it would have broke here when it broke up into the market and pulled back into this fair value gap perfectly, just coming underneath and then taking off again to the upside. So you can now clearly see that when we're looking at trends, you want to be looking for what is in the market. Where is it up to in the market now? Is it a breaker structure? Is it a market structure shift? Is it a change of character? You need to know where you're up to know what's happening next. Then what you start doing is you start looking, right, we're either A, going to break the structure again and move to the upside or downside, or B, we're going to then create a market shift to the opposite side of the market to start the move back where it come from. That's what you've got to learn when you're looking at this like that. Okay, so I'm going to give you the official what it says about it. Okay, so breaks of structure occur when the price breaks through a significant level that's previously defined as a market trend. In an uptrend, a breaker structure is indicated by a lower low, whereas the downtrend is a higher high. Breaker structure serves as a potential indicator of market reversals, and it's used by traders to confirm after initial indicators or indicator suggested that the change of direction would happen, i.e. your market shift or your change of character. The breaker structure also helps identify strategic entry and exit points in trading, guys. Considerations and challenges. Again, with false breakouts, you could have a breaker structure and it moves to the other side. You have to be careful of any fake outs. Make sure that your trade is going with the trend. And any contractual analysis would be that the broader market. So you need to know what the bigger picture is saying before you start taking any trades or counter trades. As well as that, I teach everyone this patience and confirmation. You need as much confirmation as possible, and you need to have a lot of patience in trading. Otherwise, you're not going to have many wins, and it could lead to a lot of losses. Okay, so breaker structures are powerful tools for technical analysis. It helps to provide traders with insights into potential trend reversals. This is introduction to breaker structure. Again, I'll see you on the next video.